Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to helping investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to the 11th session of Money Simplified on your guide to money and mutual funds. We are glad to have you with us for the 11th session on some myths about mutual funds. Alright, so now let's get started. In one of our earlier learning sessions, we learned that mutual funds are an effective engine to root your investments in the securities market. They offer several advantages over direct stock picking, such as diversification, professional fund management, lower expenses, economies of scale, liquidity, etc. But despite all this, very often we see investors surrounded by myths about investing in mutual funds. In a world filled with information, we do recognize that many of us develop our own set of beliefs and judgments. But it is vital to recognize that whether we are living in plain truth or delusions. In this session of Money Simplified, we would like to clarify some of the common myths on investing in mutual funds and endeavor to make you more informed so that you can take prudent investment decisions. You see, our experience shows that myths which many investors have about investing in mutual funds can be classified into two parts: myths based on incorrect beliefs and myths based on incorrect facts. So let's understand each of them in detail. Myths based on incorrect beliefs. The first myth is mutual funds lack the excitement. This is the common discourse which many have about investing in mutual funds. They say they are dull and boring. Well, mutual funds may lack the excitement of the stock market, but is the kind of excitement that investors can do without for long-term health of their wealth. Mutual funds may not give an impetus to the investor's portfolio in a bull run like some exciting stocks do, but you may be cushioned better during the downside of the equity markets. Then the second myth is mutual funds are too diversified. Many investors believe that stock portfolio of 8 to 10 stocks will generate a more attractive return than a mutual fund which may hold more number of stocks. Many may argue that seasoned investors successfully manage a small portfolio over a long period of time. But not too many investors can claim to have investment discipline, insight, and the experience. You see, a concentrated portfolio adds risk while a well-diversified portfolio mitigates risk. Then the third myth is mutual funds are expensive. Mutual funds on an average charge about 2.25% to 2.5% of the daily net assets as a recurring expense which go towards meeting expenses like brokerage cost, custodial cost, fund management costs, etc. But some of these expenses are incurred by you as a stock investor as well. In fact, if you are frequently churning your stock portfolio, as an investor, you are eventually paying much more. Then there are myths based on incorrect facts. The first myth here is a mutual fund scheme invests in the same stocks as its benchmark index. Well, the benchmark index only serves the stated purpose, that is benchmarking returns. It offers investors the opportunity to evaluate funds' performance. It need not always constitute that an actively managed mutual fund scheme would invest in stocks that form a part of the benchmark index. A number of investors believe that a mutual fund always invests in the same stocks that constitutes its benchmark index. For example, if the S&P BSE Sensex is the benchmark index for a fund, then it is expected to invest in the same 30 stocks that form the S&P BSE Sensex. This is true only in case of index funds, that is passively managed funds that attempt to mirror the performance of a chosen index. In all other cases, that is, in actively managed funds, the fund manager is free to invest in stocks from within or outside the benchmark index. Then the second myth here is mutual funds invest up to 35% in debt. While such an allocation may form a part of the investment mandate of equity mutual funds, they may not use the mandate in stricter sense to invest in debt. In other words, the intention here is to be true blue equity fund that is almost entirely invested in equity instruments at all times. They usually invest a diminutive portion in a debt and or hold cash, but not always to the tune of 35% with the intention of curbing losses in a falling equity market. So clearly, benefiting from investment opportunities in the debt market by being invested therein at all times is not the intent. The third myth here is funds with more star or higher rankings provided by independent third-party agencies make better buys. At best, rankings and ratings can serve as a starting point for identifying a broader set of investment-worthy funds, but they are not the end to pick up winning mutual funds. Fund ranking and rating have gained popularity over the years. A higher ranking rating is construed as a sign of the fund being a good investment avenue. Often many investors pick mutual funds for their portfolio based on rankings and ratings assigned to them. But sadly, what investors fail to realize is that often rankings and ratings are based on past performance of the funds. Most ratings do not provide adequate weightage to the qualitative aspects of analyzing mutual funds, such as portfolio characteristics, fund expenses, portion of AUM actually performing, fund manager's experience, and number of schemes managed by them, investment processes and systems, amongst others. Secondly, rankings or ratings are known to change over a period of time in line with the change in the fund's performance. You see, funds' rankings or ratings operate on the rationale that one size fits all. They fail to reveal who should invest in the fund based on the risk appetite and risk tolerance. The fourth myth here is, once the fund house makes the grade, so do all its funds. Just because the fund house makes the grade, it does not necessarily mean that all its funds are worth investing in. Here the proverb, one swallow does not make a summer, is appropriate. Investors often make the mistake of confusing the fund for its fund house. That is, they assume that simply because mutual fund scheme belongs to a renowned fund house, it's worth investing in. Such an investment approach is far from correct. It is not uncommon to find mutual fund schemes that have either lost focus on account of persistent change in positioning or have fallen out of favor within the fund house itself on account of their lackluster investment themes. So you as an investor should not be under this notion while investing in a mutual fund scheme. In addition to the myths we just spoke about, we will now tell you about some common myths that investors have about SIP investing. Some common myths about SIP. As you may know, apart from investing in a lump sum manner, mutual funds also offer a facility to invest systematically by enrolling for a systematic investment plan. There are investors who seem to have some misconceptions about investing in mutual funds via the SIP mode. For example, only small investors go in for SIPs. That's a misconception or a myth. Please note that SIP stands for Systematic Investment Plan and not Small Investors Plan. They infuse a disciplined investment habit of investing regularly and provide you the benefit of compounding along with rupee cost averaging. The fact is, they infuse a regular saving habit that most of us have followed while we maintained a piggy bank where we all saved some money every day or week or month to build a corpus at the end of a particular period, but with the market-linked rate of return earned over it, it may help you even achieve your financial goals. Moreover, they provide the benefit of compounding along with rupee cost averaging. The second myth in SIP investing is rupee cost averaging can be done in a stock itself. Then why SIP? SIP experimented on a single script can expose you to more volatility, unless SIP in a mutual fund scheme which reduces the risk due to diversification provided by mutual funds. As per the market capitalization bias followed by a mutual fund scheme, you can also strategically structure your portfolio depending upon your risk appetite. Similarly, you can structure your portfolio on the basis of the market caps, that is large cap, mid cap, multi cap, flexi cap, etc., or style of investing, that is value style, growth style, or blend style, followed by the mutual fund scheme. Thus, SIP mode of investing in mutual fund schemes can provide you with diversification across style and market caps and thus offer better rupee cost averaging. But it should be noted that rupee cost averaging neither ensures you profit nor protects you from making a loss in a declining market. The third myth in SIP investing is SIP mutual fund schemes are different from lump sum mutual fund schemes. The fact is, SIP is just a mode of investing. There are no special mutual fund schemes for investment. All you need to do is select a mutual fund scheme prudently for your portfolio, which may help you with better returns in the long run. The fourth myth in SIP investing is lump sum investments cannot be done in a mutual fund scheme where a SIP account exists. As mentioned earlier, SIP is just a mode of investing. Hence, investing a lump sum amount to a mutual fund scheme where a SIP exists is possible. So say you have an SIP installment of rupees 1000 per month going on in a mutual fund scheme, and suddenly if you have a surplus of rupees 50,000, then you can invest this lump sum amount to your ongoing SIP account as well. The fifth myth in SIP investing is I'll be penalized if I miss 1 or 2 SIP dates. Since an ECS mandate is usually signed, the question of missing dates does not arise. Also, on the SIP date, if you do not have sufficient funds in your bank account, you aren't penalized by the AMC. You will simply miss the SIP installment, but your account will remain active. So it's not like the EMI on your loan where you miss an installment and you're penalized. The sixth myth in SIP investing is markets are at a low to start a SIP. Lower level markets can in fact be the right time to start an SIP and gain from the upside. Buying low is better than buying high. You see, when the markets start correcting, you would be accumulating more number of units with every fall in the NAV, thus enabling you to lower your average purchase cost. And when the market surge once again post correction, you would gain as the yield works out to be higher than the lump sum money invested at higher level. Remember, SIPs help you to manage the swings of the markets better. Therefore, don't unnecessarily try to time the markets, as it is not always possible. The seventh myth here in case of SIP investing is, in case of SIP in tax saving mutual fund schemes, entire money can be withdrawn after 3 years. The fact is, your every installment of SIP should have completed the lock-in period of 3 years for you to be in a position to withdraw in case of a tax-saving mutual fund scheme. Very often investors have this myth while investing in a tax-saving mutual fund scheme. But as said earlier, your every installment of SIP should have completed the lock-in tenure. So say if you put rupees 5,000 through SIP in the month of November 2013, the lock-in period for one installment, that is of November 2013, will get over or free in November 2016. Now that we have seen various myths about investing in mutual funds, here are some points to remember before we end our today's learning session. Excitement is not good for one's investment portfolio in the long run. Yes, mutual funds do like the excitement of investing in stocks, but it's the kind of excitement that you as an investor can do without for your long-term wealth and health. Diversification benefit offered by mutual fund investing helps you to reduce risk. Actively managed mutual fund schemes do not necessarily invest in the same stocks as its benchmark index. The benchmark index only serves the stated purpose, that is benchmarking in case of actively managed mutual funds. It offers investors the opportunity to evaluate the fund's performance. Never invest in mutual fund schemes solely on the basis of star rating or ranking. Star rating or ranking can serve as a starting point, but they aren't the end to picking winning mutual fund schemes. You see, fund ranking or rating fail to reveal who should invest in the mutual fund scheme based on the risk appetite and risk tolerance. Never invest only on the basis of the fund house. Investors often make mistake of confusing the mutual fund scheme for the fund house. They assume that simply because a mutual fund scheme belongs to a renowned fund house, it's worth investing in. But this isn't the prudent approach to select winning mutual fund schemes. SIPs infuse regular investing habit. SIPs offer the benefit of rupee cost averaging and compounding, which helps you to manage the market volatility better as compared to stocks. Mutual fund schemes for SIP investments are the same as those for lump sum investments. There aren't any separate mutual fund schemes for SIP investing, please remember. There is no penalty for missing an SIP installment. SIP in a tax-saving mutual fund scheme has a lock-in tenure for each installment. So to end our learning session today, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.